At just 6 years old, a little boy went door to door selling Coca-Cola bottles to make ends meet. He delivered newspapers in the mornings, but deep inside, he struggled with the scars of mental abuse he suffered from his mother, an experience that left him fearful of talking to people. Yet, that very same boy would one day rise to become not only the richest man in the world, but also the one people revere as the god of the stock market. This is the story of Warren Buffett. So, how did a child who started from the very bottom transform into the greatest investor the world has ever seen? Let's dive deeper. Warren Buffett was born on August 30, 1930, in Omaha, Nebraska. Just a year earlier, the Great Depression had struck America, lasting until 1939. It was one of the darkest times in U.S. history. Living standards collapsed, and families struggled even to afford the basics. During this period, Warren's father, Howard Buffett, lost his job at a bank. With no choice left, Howard used his savings to start his own small company, selling stocks and bonds. But the economic crisis had already forced the Buffett family into hardship. Young Warren grew up with a clear understanding: money wasn't just important, it was survival. Watching his father work sparked his interest in finance. He became curious about the world of stocks, bonds, and investments. But Warren's childhood wasn't easy. He was a shy, introverted boy who avoided making new friends. The biggest reason for this was the mental trauma he faced at home. His mother, Layla Buffett, came from a family history of mental illness, and her own condition was unstable. She often lashed out at Warren and his sister with verbal abuse. For most of us, mothers are our protectors, the source of unconditional love and comfort. But Warren's reality was different. The harshness at home left deep scars, especially when he saw other children receiving affection from their parents. These experiences pushed Warren further away from the outside world. Most of Warren's childhood was spent inside his father's library, where he developed a deep friendship with books. It was here that his fascination for investing and business truly began to grow. At just 6 years old, Warren came up with his very first business idea. He visited his grandparents, who ran a small neighborhood grocery store, and asked them, "Could you give me a few bottles of Coca-Cola so I can sell them door to door?" At first, his grandparents hesitated. After all, he was only 6. But Warren was persistent, and eventually, they agreed. That's how young Warren Buffett launched his very first business. From each 6-pack of Coca-Cola he sold, he earned just a few cents in profit. But even then, Warren wasn't satisfied. He wanted more. Soon, he added chewing gum and magazines to his little business empire. By the age of 11, Buffett was already thinking bigger. He made his very first investment in the stock market, buying shares of an oil and gas company called City Service. The price per share was $38. Not long after, the stock dropped to $27. Warren was disappointed, but he held on, believing that in the long run, the price would rise again. He made himself a promise: "I won't sell until it hits $40. And sure enough, after some time, it did. Warren sold his shares for a small profit, an early taste of success in the investing world. Warren sold his first stock too early. He had made only a small profit when he decided to cash out. But just a short time later, those same shares skyrocketed to over $200. Watching the missed opportunity unfold, young Warren felt deep regret. True wealth is built by investing for the long term. A few years later, Warren's father was elected as a U.S. congressman, and the Buffett family moved from Omaha to Washington, D.C. By the age of 14, Warren was delivering newspapers, earning about $79 a month, the equivalent of nearly $3,000 today. Ambitious as ever, Warren saved his earnings and partnered with a friend to buy a used pinball machine for $25. They placed it in a local barbershop so customers waiting for their turn could play while passing the time. It was a win-win situation. Warren made money from the machine, and the shop owner earned a commission. The idea wasn't random. When Warren was just 10 years old, he had read a book titled 1,000 Ways to Make $1,000. One of the chapters described the pinball machine business, and ever since, the idea had been stuck in his mind. As expected, the first machine was a success. Warren reinvested the profits to buy more machines, slowly building a small arcade empire. Eventually, he sold the entire business for $1,200, a huge sum at the time. With that money, Warren bought his very first property, a 40-acre farmland. Warren was just 15 years old when he bought his first farmland. That single achievement made it clear the boy from Omaha was destined for something extraordinary. By 1947, he had completed high school and was eager to jump straight into the stock market as a full-time broker. But his father disagreed. Howard Buffett insisted that Warren continue his education. Respecting his father's wishes, Warren enrolled at the University of Pennsylvania, funding his own studies with the rental income from his farmland. He earned a degree in business administration, and afterward, he set his sights on Harvard University for his master's program. Confident and ambitious, Warren applied, but to his shock, he was rejected. At the time, it felt like a huge setback. But in hindsight, that rejection was one of the greatest blessings of his life. Because instead of Harvard, Warren enrolled at Columbia Business School. And it was here that he met the man who would change his life forever, Benjamin Graham. Graham was not just a professor, he was a legendary economist and investor, widely known as the father of value investing. That very same year, he had published a groundbreaking book titled The Intelligent Investor. Warren devoured it, admiring Graham's ideas and soaking in every word of his lectures. Eager, disciplined, and deeply curious, Buffett quickly became Graham's favorite student. And in turn, Graham became Warren Buffett's greatest mentor, the man who laid the foundation for his future as the world's most successful investor. After completing his master's degree in economics, Buffett was excited to begin his career. He dreamed of working near the beating heart of finance right around the New York Stock Exchange, where the biggest investment firms operated. But Warren faced one major obstacle. Despite his sharp mind and deep knowledge of investing, he was painfully introverted. He feared speaking to people, and the anxiety was so severe that it sometimes made him physically ill. Buffett realized that unless he conquered this fear, he could never succeed. Summoning all his courage, he enrolled in a public speaking course. And that decision and investment in himself turned out to be one of the most profitable investments of his life. It gave him the confidence to stand in front of people and speak without fear. Not long after, Warren received a life-changing call. Benjamin Graham himself reached out and offered him a job at his investment firm. For Buffett, it was the perfect opportunity not only to work, but to keep learning from the master he admired most. He eagerly accepted. At Graham's firm, Buffett learned the practical skills of security analysis and how to calculate the true value of companies. But as he worked, Warren began to notice something important. His own investing philosophy was starting to differ from Graham's. While Benjamin Graham focused almost entirely on numbers, balance sheets, and undervalued stocks, Buffett believed just as strongly in looking at the quality of a company's management. Despite their differences, the two respected each other's work and maintained a strong balance. During his time at Graham's firm, Buffett constantly researched new companies. One that caught his attention was a New York-based chocolate maker called Rockwood & Company. At the time, Rockwood was struggling. The sudden surge in cocoa prices had eaten into its profits, and the stock was beaten down. Buffett saw an opportunity. He believed that once market conditions stabilized, the company would bounce back. So, in a bold move, Warren invested 75% of his total savings into Rockwood. Graham repeatedly warned him no investor should ever risk so much money in a single company. But Buffett followed his conviction, knowing both his reputation and his future were on the line. If Rockwood failed, he would not only lose his money but also the respect of his mentor. Everything was at stake. Fortunately, Buffett's instincts proved right. By the early 1950s, the economy recovered, cocoa prices fell, and Rockwood returned to profitability. The gamble paid off handsomely, and Buffett earned a massive profit. This victory gave him more than just money, it gave him the confidence that his own approach to investing could work. Warren Buffett had always been a firm believer in value investing. By the mid-1950s, the U.S. economy had bounced back, and in 1956, Warren began planning his next big move. His idea was to form a partnership with Graham Newman, the very firm founded by his mentor, Benjamin Graham. But then came an unexpected twist. Graham had lost interest in the investment business. He felt he had already earned enough money to live comfortably and decided to retire, stepping away from Wall Street to enjoy the rest of his life. For Warren, it was a huge shock. Suddenly, the clear path ahead seemed uncertain. He realized he had something just as valuable: capital, knowledge, and the experience of running an investment firm. So at just 25 years old, Warren Buffett made a bold decision. He left New York, returned home to Omaha, and started his very own investment partnership. He called it Buffett Partnership, Ltd. Despite having the funds, Buffett avoided unnecessary expenses. He didn't rent an office or hire a staff. Instead, he ran the entire business out of a single room in his own house, managing everything by himself. At the start, he had only 7 partners, mostly close friends and family, who collectively invested about $5,000. But with Buffett's principles of value investing and his growing reputation for generating profits, that modest beginning would soon grow into something far greater. Influenced by his mentor Benjamin Graham, Buffett focused on buying undervalued stocks, companies trading far below their true worth. But Warren soon decided to take the idea to the next level. Instead of just undervalued businesses, he began seeking out companies that were nearly collapsing, firms with poor management, struggling operations, or industries facing headwinds. In other words, companies that looked almost dead. Buffett would buy their stocks at dirt cheap prices and wait patiently for them to recover to their intrinsic value. This approach became famously known as the cigar butt strategy. The idea was simple: imagine finding a discarded cigar butt on the street. It may look useless, but it still has one last puff left. You pick it up, take that free puff, and move on. In the same way, Buffett picked up beaten-down companies, took whatever profit they had left, and then sold them once their value rebounded. The strategy worked brilliantly. By the early 1960s, Buffett's partnership, originally started with just $5,000, had grown to an astonishing $7.2 million in assets. Buffett's own personal net worth had soared to over $1 million, a massive fortune for someone still in his early 30s. As word spread of his consistent success, more and more people lined up to invest with him. Warren Buffett was no longer just a promising investor from Omaha, he was quickly becoming a force on Wall Street. Despite Buffett's remarkable track record, not everyone trusted him in the beginning. Even though he was in his 20s, Warren still looked like a teenager. Some potential investors hesitated, wondering, can this 18-year-old looking kid really manage our money? But those who took the leap of faith were richly rewarded. From 1956 to 1968, Buffett delivered an average annual return of 29.5%. To put that into perspective, while a traditional bank deposit earned just 5 to 6%, Buffett was generating nearly 6 times that amount every year. His reputation grew rapidly. Within just a decade of starting his partnership, Buffett was managing over $44 million on behalf of his clients. And in the next 3 years, that figure more than doubled, soaring to $104 million under management. But then came a turning point. In 1962, Buffett made what he would later call the biggest mistake of his life. At the time, a struggling textile company named Berkshire Hathaway perfectly fit his cigar butt strategy. It was cheap, unloved, and bleeding losses. Spotting an opportunity, Buffett began buying shares, eventually acquiring enough to become the company's majority owner. By 1964, Berkshire's longtime owner, Seabury Stanton, began to fear that Buffett was planning a takeover. To avoid this, Stanton invited Buffett to a meeting and offered a deal: he would buy back Buffett's shares at a premium price. For Warren, it seemed like a golden opportunity. Instead of the agreed $11.50 per share, the letter listed the price as only $11.32. It was a small difference, but to Buffett, it wasn't about the money. It was about trust. He felt Stanton had betrayed him. Fueled by anger, Buffett decided to teach Stanton a lesson. Instead of selling, he doubled down, buying more and more shares until he gained full control of Berkshire Hathaway. Once in charge, he promptly fired Seabury Stanton. But as the dust settled, Buffett realized the magnitude of his mistake. He now owned a failing textile business, one whose losses kept piling up. Later, Buffett would call this decision to buy Berkshire his worst investment ever. He admitted, "I let my emotions guide me, and emotions have no place in investing." Still, Warren wasn't one to accept defeat. If he was stuck with Berkshire, he was determined to make something of it. For years, he tried to keep the textile operations afloat, but the numbers never improved. Finally, in 1967, Buffett made a radical move, one that nobody could have predicted. He transformed Berkshire Hathaway from a dying textile company into a holding company, a vehicle that could buy and invest in other businesses. And with that bold decision, Buffett turned what seemed like a disaster into the foundation of one of the greatest financial empires in history. Up until this point, everything was going perfectly. Buffett was winning big, and so were his partners. But then, he noticed something unsettling. The market was too optimistic. Prices were soaring, and investors seemed blinded by greed. That's when Buffett recalled one of his guiding principles. Be fearful when others are greedy, and be greedy when others are fearful. To him, the rising stock prices weren't a sign of strength, they were a warning. A crash could come at any time. And Buffett wasn't willing to gamble with other people's money. So, in 1969, at just 39 years old and already worth $25 million, Warren Buffett did the unthinkable. He shut down his investment partnership. Despite his wealth, he still carried the scars of his Berkshire Hathaway mistake. That failure had taught him a valuable lesson: strategy matters. It was around this time that Buffett's most trusted partner, Charlie Munger, stepped in with game-changing advice. Instead of buying fair companies at great prices, Munger told him, focus on great companies at fair prices. The idea was simple but powerful: buy outstanding businesses when they're trading low enough to minimize risk. Buffett loved the logic. From then on, his hunt was no longer for cheap stocks, it was for quality companies. That search eventually led him to one of the most iconic brands in history, Coca-Cola. A company that had dominated the market for over a century, untouchable, unmatched, and deeply loved by consumers worldwide. By 1989, Warren Buffett finally acted on his conviction. Through Berkshire Hathaway, he invested nearly $1 billion to purchase 6.2% of Coca-Cola. That single move set the stage for a new era. Buffett also placed bold bets on giants like American Express and the Washington Post. This strategy, backing world-class companies and holding them long-term, proved to be a game-changer. In the early 1990s, Berkshire invested $300 million in Gillette. Within just 2 years, that stake was worth nearly $500 million. From there, the list of powerhouse investments only grew: McDonald's, PNC Bank, and NetJets, a private aviation company. The results were staggering. In 1990, Buffett's net worth stood at about $3.3 billion. By the end of the decade, it had exploded to $36 billion. And he didn't stop there. In the 2000s, Berkshire took significant positions in Goldman Sachs and Bank of America. These deals generated massive profits, and by 2008, Warren Buffett had officially become the richest man in the world with a fortune of $62 billion. But then came a surprising twist. In June 2006, Buffett announced that he would donate 80% of his wealth to charitable foundations. Later, in 2020, he raised that pledge to an astonishing 99%. That means when Buffett is gone, virtually his entire fortune will go to philanthropy. It's a breathtaking gesture of generosity, proof that Warren Buffett isn't just a legendary investor, he's also one of the greatest humanitarians of our time. If you found Buffett's story inspiring, make sure to like this video, share it with friends, and subscribe for more incredible journeys of the world's most iconic leaders.